Hey guys, it's Henry. The market has been so shaky. I mean, it's unbelievable how much the market has fallen so far this week, and nearly everyone is down some money. I mean, this doesn't even make any sense because historically when inflation is going up, stocks actually do well. January is one of the best months for the market. However, this year, whether it's rates, virus, or general fear, things are not looking so good. I'm mainly preparing for Tesla earnings, and I believe it's time to be very safe in the market. However, I don't really want to deleverage my position in Tesla because I believe they're going to report a good Q4 earnings. Now, this video isn't about Tesla, it's about the best stocks to buy in February. I'm going to focus on stocks that have sold off a good amount, as well as stocks that have some good catalysts that I believe can outperform the market in February. So today I'm going to discuss a few stocks that have good return potential for the next 2 or 3 months here, as well as greater margin of safety in case there is a further sell-off. I'm not going to lie, I have no idea what's going to happen. The market could sell off more, but in these times, I usually just hold on, have a few tears, but I don't let myself panic. I also want to let you guys know I don't typically have sponsors, but I've been using a VPN as I travel the world, and I want to share with you a special opportunity. I use a VPN for greater safety and to hide my online activity. Also, when I buy tickets, I change my address to get better deals on flights. When I was in Portugal, I put my location as Ukraine, and I saw the flights in Mexico change by $87. Plus, I needed a VPN when I was in Colombia just to be safe and protect my data. I use Atlas VPN. Right now, Atlas VPN is running a huge discount. In the description, I have a special deal for 86% off. They offered me to share with you a 3-year subscription for just $1.39 a month with a 30-day money-back guarantee. It's the best VPN deal on the market. I signed up and I'm happy to protect my data and save money for the past 10 months of traveling to Colombia, Ukraine, Georgia, Portugal, and currently in Mexico. Click the link in the video description below and try it out at no risk. All right, let's get into the first stock. Graphic chip specialist Nvidia is now trading for a huge discount to last year's levels. I did sell call credit spreads when it was $330 per share, and at those levels, it was clearly overvalued. Now Nvidia has gone down by more than $100. I mean, look at the stock's technical pattern right now. It is in a complete bear territory. However, at some point, you do want to put some money to work and catch a falling knife because it's not going to be falling down to zero. The stock has had some really high volatility, so selling options on it like puts to get in is a great idea. Growth investors with a higher appetite for risk can consider using the pullback in Nvidia to buy more shares if you don't have enough collateral. Of course, you can also sell put credit spreads at the 200 and 195 level or even lower as Nvidia continues to pull back. I believe Nvidia growth is here to stay for a few simple reasons. Analysts expect Nvidia's earnings to have a compounded annual growth rate of 40% for the next 5 years. Although there is pain in the market right now, there is no lie in the business's growth. The growth is not surprising because Nvidia dominates 2 lucrative markets, video gaming and data center GPUs, and is making notable moves in self-driving cars and the metaverse. As a huge EV investor, Nvidia is selling the shovels to the gold miners. Each vehicle needs GPUs. Year to date, Nvidia is down 20% and the PE ratio is now under 75. Very reasonable considering Nvidia is growing fast like a Tesla, while Tesla trades at a 300 PE valuation. I believe semiconductors are the new oil. Every secular tailwind you can think of involving disruptive innovation requires semiconductors. In fact, the list goes on. Data centers, cloud computing, virtual reality, autonomous driving, electric vehicles, gaming, esports, e-commerce, the metaverse, artificial intelligence, big data. Every single place that's going to have growth in the future needs semiconductors, and Nvidia is a key component of these growing industries. So as Nvidia continues to sell off, I'm continuing to look into buying shares. Now, the second stock is Amazon. I'm betting big on e-commerce. Nobody goes to the mall anymore. Everybody does their shopping online. Most people are familiar with Amazon because of its leading online marketplace. According to eMarketer, Amazon is expected to have brought in 41.4% of all online spending in the US last year. That's more than 34 percentage points higher than the next closest competitor. However, online retail sales generally yield razor-thin margins. To counteract this, Amazon has a genius idea, and they turn its annual Prime membership into a big profit center. Members receive a number of perks, including free 2-day shipping and access to Amazon's vast content library. In return, the company gets high-margin subscription revenue that helps increase margins and allows them to undercut brick-and-mortar retailers on price. It also doesn't hurt that Prime members spend more with Amazon and stay within its product and service ecosystem. Even if the market is shaky, Amazon is an easy long-term bet. The stock is currently trading for under $2,900, and currently I see it as a value play. The cloud segment of their business is also likely to continue growing and taking off. This is a high margin business, and I believe it's going to start reflecting more and more each quarter of earnings. I believe Amazon could be a $5,000 or $10,000 stock this decade. Of course, I don't know what will happen tomorrow, but I expect good performance in February, specifically because they have earnings. For the first quarter of 2022, analysts are currently modeling for Amazon's revenue to increase about 12% year over year to $121 billion and EPS to fall 33% to $10.50. I'm paying close attention to Amazon because they beat 5 out of the 6 of the last earnings numbers, and I expect a high chance of that repeating. The third stock is also a tech stock. Now, I'm not condoning buying the tech stock dip because I think a lot of stocks may continue dipping. However, I'm paying close attention to the tech stocks that have good fundamentals. Meta is what I'm looking at. Even though Meta officially changed its name from Facebook in late October, there is no question whether the lion's share of revenue for the company still originates in advertising. Based on the company's third quarter operating results, 2.9 billion monthly active users visited Facebook in Q3, with another 670 million unique users heading to Instagram and WhatsApp each month. Combined, we're talking about 3.58 billion people, or more than half of the world's adult population, interacting with a Meta-owned asset each month, and the number of mobile users is only skyrocketing. There's simply no platform around that allows advertisers to reach so many eyeballs, which is why Meta enjoys such incredible ad pricing power. As I've previously noted, Meta hasn't come close to fully monetizing its core assets yet. Even though it likely generated more than $100 billion in ad revenue last year, nearly all of this came from Facebook and Instagram. Assuming Facebook eventually pulls monetization levers on WhatsApp and Facebook Messenger, it'll be able to drive additional sales and profits to an already fast-growing business. The closer Meta stock gets to $300 per share, the more excited I get to purchase shares. And currently, with the Monday sell-off, Meta is actually under $300 per share. I expect the stock to see a lot of growth as soon as the market recovers. In 2022, all eyes seem to be on the metaverse, the next iteration of the internet designed to allow users to interact in 3D virtual environments. Facebook is aiming to be a leader in virtual reality with its Oculus devices, and it invested $10 billion last year in metaverse-related products and services. With Microsoft recently buying Activision Blizzard for $69 billion, it's clear big tech is very focused on the metaverse. Also, it's not often that you can find a company that's near a $1 trillion market cap that's continuing to grow by approximately 20% on annual basis, and it's valued at roughly 20 times earnings for this year. Meta looks like an absolute bargain going into February, and I think it's a good hedge in a risky portfolio. Next stock I have is NIO. Boy, has NIO sold off a lot. I've gotten out of the stock in the mid 30s. I've warned investors of the stock. I love this stock. I think it's a good long-term bet. But in the short term, I said there's way too much risk with China. The Chinese news is completely manipulating and putting pressure on Chinese stocks, and no amount of analysis I can do can help if China continues to manipulate and crush investment opportunities with fear, doubt, uncertainty, all of these negative things that is in the media. But I'm starting to gain hope, especially with the Monday sell-off, that NIO is literally around $20 per share. I'm hoping that the worst is behind us and NIO is starting to look good for someone looking to dollar cost average. Although shares of the company looked very expensive at this time last year, management has done an excellent job of ramping up production, even with persistent supply chain issues plaguing the auto industry. In November and December, NIO delivered nearly 10,900 EVs and 10,500 EVs respectively, putting it on track for an annual run rate of 130,000 EVs. Thanks to organic growth and the expected introduction of 3 new vehicles, the expectation is for the company to be producing an annual run rate of 600,000 EVs by the next 12 to 24 months. NIO's battery as a service program is also genius. Introduced in August 2020, The BaaS program allows buyers to charge, swap, and upgrade their batteries, as well as receiving a discount on the initial purchase price of their EV. In return, buyers pay a monthly fee to NIO. The company is effectively foregoing a little short-term, low-margin revenue for higher margin, long-term cash flow and improved customer loyalty. Even with all the fear, uncertainty, and doubt from China, I believe NIO is starting to become a bargain around $24 per share. Last stock I believe has tremendous potential in February is Tesla. Now, in the next couple of days, Tesla is reporting earnings. For Q4, this is historically one of the best quarters for Tesla, and Tesla currently sits around $850 per share, and I'm completely terrified because I have so many shares. However, when I look at the general market, everything is selling off. Bitcoin is around 33,000. There's literally no place to hide, so I can't feel bad about my Tesla position. When I think about the long-term trajectory of where Tesla is headed, it doesn't make any sense for me to sell my shares, even though I'm losing 6 figures in one single day. Now with Tesla, I'm paying close attention to earnings and I'm looking for this stock to outperform in February. My price target for Tesla this year is about $1,300 per share in my base case scenario. Therefore, there's nearly 40% upside, and I'm going to continue holding Tesla along with all the other stocks that I mentioned in this video. Don't forget, Atlas VPN is 86% off using my special link in the description and in the comments section. Make sure that you protect your data security on public Wi-Fi, government, app advertisers, and at the end of the day, save money on purchases for $1.39 a month with Atlas. I'll see you guys back here very soon. Stay patient in the market and invest very safe.